Have you ever wondered how the stock market works? Let's dive right in. At its core, the stock market is like a grand bazaar for trading ownership in companies. This grand marketplace is also known as the equity market or share market. Here, individuals and institutions engage in the buying and selling of shares in publicly traded companies. But why does it exist? Well, it serves a dual purpose. Firstly, it's a platform where companies can raise capital. They do this by selling parts of their business in the form of shares. This is what we call going public or conducting an initial public offering. Secondly, it's a place where investors like you and me can buy and sell these shares. The beauty of it is that when you buy shares, you're essentially buying a piece of the company. You become a shareholder and gain a claim on part of the company's assets and earnings. Now let's talk about stocks and shares, because these terms are often used interchangeably. Technically, stock refers to the ownership certificate of any company, while shares refer to the ownership certificate of a specific company. So if you own shares, you own a piece of stock in a company. Now you might be wondering, where do these trades happen? They happen on platforms called stock exchanges. You may have heard of some of the major ones like the New York Stock Exchange or NASDAQ. These are essentially marketplaces where stocks are listed and traded. In the grand scheme of things, the stock market plays an integral role in the global economy. It's a place where companies can grow by raising capital, and where individuals and institutions can potentially profit from the performance of these companies. So, there you have it. In essence, the stock market is a marketplace for buying and selling ownership in companies. But remember, as with any marketplace, it's important to understand what you're buying. So let's buckle up and delve deeper into how the stock market truly works. Now you might be asking, how does the stock market function? Well, the stock market operates much like an auction house. It's a bustling hub of activity where buyers and sellers negotiate prices and make trades. The auctioneers in this scenario are the stock exchanges, such as the New York Stock Exchange and NASDAQ. These exchanges provide a controlled environment where stock transactions can take place. Picture a bustling marketplace, but instead of fruits, vegetables, or other goods, the items being traded are shares of publicly traded companies. Each share represents a tiny piece of ownership in a company. When you buy a share, you're buying a piece of that company's future success or failure. The stock market is a vast ecosystem teeming with different types of participants. There are individual investors like you and me who might buy a few hundred or a few thousand shares at a time. Then there are institutional investors, entities like mutual funds, pension funds, and hedge funds that buy and sell millions of shares at a time. So, how are stock prices determined? It's a dance of supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell a stock than buy it, the price goes down. This dance is influenced by a myriad of factors, from a company's earnings reports to global political events. Now, with thousands of stocks being traded, how do we measure the overall health of the market? Enter the concept of market indices. An index is essentially a basket of stocks that represents a snapshot of the market. Some popular indices include the S&P 500, which consists of 500 of the largest U.S. companies, and the Dow Jones Industrial Average, which includes 30 significant U.S. companies. So stock prices fluctuate based on supply and demand, and indices give us a snapshot of the market's overall performance. And that, in a nutshell, is how the stock market works. What does it mean to invest in stocks? Well, when you invest in stocks, you're buying a piece of a company. You become a shareholder, sharing in the company's success, and sometimes, its failures. There are different types of investors, each with their unique approach to the stock market. Day traders, for instance, are like the sprinters of the investing world. They buy and sell stocks within a single day, hoping to profit from short-term price fluctuations. Swing traders, on the other hand, hold on to stocks for days or weeks, capitalizing on trends over a slightly longer period. Then we have the long-term investors, the marathon runners. They buy stocks and hold on to them for years, sometimes even decades. They're less concerned about daily market fluctuations and more interested in the company's long-term growth potential. Now, let's talk about the elephant in the room: risk. Investing in stocks can be risky. Prices can go down as well as up, and sometimes companies even go bankrupt. But here's the thing: with greater risk often comes greater potential reward. The stock market has historically provided higher returns than safer investments like bonds or savings accounts. So, how do you manage this risk? One common strategy is diversification. Imagine putting all your money in one company's stock. If that company goes under, you could lose all your investment. But if you spread your money across different companies, sectors, and even countries, you're less likely to lose everything if one stock performs poorly. Think of it like a buffet. Instead of filling your plate with just one dish, you sample a little bit of everything. That way, if one dish doesn't taste good, it won't ruin your entire meal. That's diversification in a nutshell. Remember, diversification is a key strategy to manage risk in stock investing. And while investing in stocks can seem intimidating, with the right knowledge and strategies, it can be a way to grow your wealth over time. But as always, it's essential to do your research and consider seeking advice from a financial advisor. So, how can you start buying and selling stocks? Well, the first step is to open a brokerage account. This is essentially your gateway to the stock market. It's an account you can create either online or through a traditional brokerage firm. Once you've set up your account, you'll be able to start trading stocks. But before you jump in, it's important to understand the different types of orders you can place. There are two primary types: market orders and limit orders. A market order is a request to buy or sell a stock immediately at the best available price. It's like saying, I want to buy this stock right now at whatever price it's going for. On the other hand, a limit order is a request to buy or sell a stock at a specific price or better. It's like setting a budget for yourself. You're saying, I want to buy this stock, but only if it's at this price or lower. Or, I want to sell this stock, but only if I can get this price or higher. Now, as you start trading, you should be aware that this isn't a free service. Brokerages often charge fees or commissions for their services. Some might charge a flat rate per trade, while others might charge a percentage of the total trade value. These fees can add up, especially if you're making a lot of trades, so it's essential to factor them into your investment strategy. Some brokerages offer commission-free trades, but make sure to read the fine print to understand what you're signing up for. Remember, investing in the stock market is not a guaranteed way to make money. It's a complex system that requires research, strategic planning, and a willingness to take on risk. But with a solid understanding of how to buy and sell stocks, you're one step closer to navigating this exciting world of investing. With a brokerage account, you can place orders to buy or sell stocks, but be aware of any associated fees. How can you make informed decisions in the stock market? That's a question every investor grapples with. The answer lies in market analysis. There are two primary tools that investors use: fundamental analysis and technical analysis. Fundamental analysis involves examining a company's financial health. This includes scrutinizing balance sheets, income statements, and cash flow statements. It also considers factors such as the company's earnings, its growth potential, and the broader economic climate in which it operates. Technical analysis, on the other hand, is all about studying historical price and volume data. The goal here is to identify patterns and trends that might help predict future price movements. This approach assumes that all relevant information is already reflected in a stock's price. In essence, fundamental analysis tries to determine a stock's intrinsic value, while technical analysis focuses on chart patterns and price trends. Both tools are essential for making informed decisions in the stock market. Fundamental and technical analysis can help predict stock performance and guide your investment decisions. What strategies can you adopt in the stock market? Well, just as there are many ways to climb a mountain, there are many strategies to conquer the stock market. One approach is long-term investing. This strategy involves buying stocks with solid fundamentals and holding onto them for years, expecting them to grow. It's like planting a tree and waiting for it to bear fruit. Long-term investing requires patience and a calm demeanor, as it means weathering the ups and downs of the market. On the other hand, there's day trading and swing trading. These are short-term strategies that involve buying and selling stocks within a day or a few days, respectively. They're like catching waves on a surfboard. These strategies require a keen eye for trends and patterns, quick decision-making, and an appetite for risk. Different strategies cater to different investment goals and risk tolerance levels. Choose wisely, and let your strategy be your guiding star as you navigate the vast ocean of the stock market. What regulations govern the stock market and what risks should you be aware of? Let's delve into that. The stock market doesn't operate in the Wild West. It's tightly regulated by government agencies like the Securities and Exchange Commission in the United States. These regulatory bodies work to ensure fairness, transparency, and trust in the market. They set rules, enforce laws, and take action against fraudulent activities. Now, onto risks. Investing in the stock market isn't a guaranteed path to riches. Economic conditions, geopolitical events, and company-specific factors can all affect stock prices. Market volatility can lead to significant losses, especially for those engaged in short-term trading. Risk is an inherent part of investing. It's the flip side of the potential for high returns. But understanding these risks, diversifying your portfolio, and investing for the long term can help manage them. While the stock market offers opportunities for wealth creation, it's important to be aware of the inherent risks and the role of regulatory bodies in ensuring fairness. To wrap up our introduction to the stock market, let's take a moment to recall the key points we've covered. We've learned that the stock market is a financial marketplace for buying and selling shares in publicly traded companies. We've discovered how the stock market operates, with stocks representing ownership in a company and prices determined by supply and demand. We've explored the different types of investors and the potential risks and rewards involved in investing. We've outlined steps on how to buy and sell stocks using a brokerage account, and the significance of both fundamental and technical analysis in making informed investment decisions. We've also touched on various investment strategies, from long-term investing to day and swing trading. Lastly, we've highlighted the importance of regulatory bodies in maintaining fairness and transparency, and the various market risks that can impact stock prices. Remember, the stock market is a complex entity offering both opportunities and risks. Further education and consultation with a financial advisor can provide in-depth knowledge and guide your investment journey.
Thank for the watching. Subscribe. Don't forget to like this video.